Zalamia, PH.
Hello, everybody. Good morning. Good morning to our speaker, Marvin. Good morning.
Good morning, everyone. Good morning, RB. Right.
Yeah. So happy Thursday, everybody. It's good to see many of you here again this morning. Thank you for all the greetings in the chat box. We're seeing them. Um, and it's good to know that you can hear us well and you could see us clearly. So, ayan. So, audit season has started. That's why probably a lot of you are also here this morning to understand more about the accounting valuation that we're doing. For most of you, actually, Marvin and I were surprised that we're expecting close to 500 attendees this morning. So we haven't had that for quite some time. Actually, 450 registrants now as of an hour ago. So yeah, thank you for joining us. It's indeed the time again of the year, Marv.
Yes. Yes. Busy season.
Busy
Yes.
season, ayan. So, yeah. So, actually, just to get a feel of our audience this morning, maybe in the chat box, just let us know, why are you here this morning? What do you want to understand, or in what stage are you in the valuation? Have you done your past 19 or accounting valuation? Are you in the process of completing the data requirements? Have you already submitted everything and is waiting for the report to come out? Or are you done with the valuation? Please let us know on the chat box so that we get to feel. So yan. So I think si Marites mentioned she wants to understand the report now. So done na. Some like Derek is just waiting for the report, waiting. So may mga pending rin pala sa amin. So that's why you're here. But yeah, we try to complete the report within 2 weeks from the time that we get the completed data. So yeah, so just waiting for the report. So very timely. So a lot of you have started, a lot of you are doing this for the first time. Some of you are doing this on a yearly basis and still wants to further understand the requirements. So at least thank you for that and for all your comments, and at least that sets the tone for this morning. So Marvin will be walking you through, the requirements, the results. We'll spend more time on understanding the accounting valuation results because in the previous webinar, we talked about the requirements and the process, right? So today's session is called Understanding Your Past 19 Results, a Guide to Compliance and Interpretation. So past 19 is the accounting standard for long-term employee benefits, including retirement obligations. It is also a common area of focus during year-end audits since it affects both recognition and disclosure in your financial statements. So, as mentioned, our goal this morning is practical. We want to leave you with a clear understanding of what drives the numbers, how to read the key results, and how to respond to the usual auditor questions with confidence. So, we will connect the valuation figures back to benefit design decisions because these assumptions and outcomes should still make sense in the context of your program. So you're very familiar with our speaker today. We are joined by Marvin Tixon. So Marvin has over 15 years of actuarial experience, also focused on retirement benefit valuations. So Marvin and his team conduct valuations for thousands of companies across different industries. And they regularly support clients not only on the technical work, but also on how to apply the results properly in financial reports. So we will run this as a short talk first, then we will open the floor for Q&A. So feel free to type in your questions in the Q&A box or in the chat box, and we will try to respond to them towards the end of the webinar. So without further ado, please join me in welcoming Marvin Tixon. Virtual round of applause. Good morning, Marv.
Right. Good morning. Good morning, RB. Good morning, everyone. Okay. So let's start. I'll be sharing my screen.
May mga request, Marv, if you can discuss the journal entries. Hindi po kami accountants, but then we get a lot of these questions, so we'll be able to share at least our little knowledge about how it connects to the journal entries. Uh,
Okay.
Yan.
All right. So for today, no. So I've seen the chat box responses, no. So we have a mix actually of clients who are just starting out their valuation process, or those who are already in the pending category, or those who have already received their reports and would just want to at least grasp what does the numbers mean. Okay. So in this webinar, so we'll try to actually encapsulate all for the meantime. No, then we'll probably have further webinars in the next months that will just focus on the interpretation in itself. Okay. All right. Let's begin. So first and foremost, core concepts. So we need to build the blocks for our valuations of retirement plan. So what is an actuarial valuation anyway? So we make use of the data that you provide to us, undergo an actuarial valuation process, and it will be part of the financial reports that is very important to the company. And it's also used as a compliance report when submitted to the SEC or even BIR from time to time. Okay. So it's a professional assessment of the financial status of employee benefit plans. Definitely uses math and statistics to estimate the present value of future benefit payments. No, so usually, actuarial professionals they're graduates of BS Math and BS Statistics. Okay, and undergo a series of exams to complete their accreditation. Okay. All right. So why does companies need it? To know what you owe, and that O is the liability for service employees have already given. To know what you have spent during the year. It's because your employees have actually provided work during the past year. Okay, so it's a liability and determining the expense. Now, for an actuarial valuation, we usually provide two. And here we'll just differentiate the accounting valuation and the funding. So at this stage, most requests would be on the accounting valuation. Okay. So the purpose of an accounting valuation is financial reporting. So usually a past 19R. But we also perform valuations for, let's say, if you're an SME and you have to report under Section 28, or even from time to time, we do have clients who would like us to support them for the small entity reporting, which is Section 22. Okay. The funding valuation, on the other hand, is to determine the contributions that you need to put into the retirement fund. Okay? So you can already see the disconnect there, no? One is you don't need to be funded, but as long as you're accruing an expense, okay? The second one is you have the intention to fund your retirement plan. Okay? Now, for the impact, accounting valuations is affecting companies' balance sheet and income statements, while on the funding valuation, it affects the company's cash flow. So the timing of accounting valuations, based on our assessment also of the SEC guidelines and how auditors would also relate to us, it's usually required annually. Okay. Funding valuations are not. So it's typically every 2 to 3 years, and especially if you have the intention to fully fund your retirement plan. Okay. And then it also differs on the assumptions used for accounting valuations. First and foremost, it's an accounting requirement. So we are heavily dependent on interest rates based on the guidelines of the Philippine Interpretations Committee of 2008-01. Okay. So that means it's not dependent on how your retirement fund performs. Okay, so it's independent of that. And besides, as I said, you might have an unfunded retirement benefit. No? So there's no interest rate to talk about. No? So we have to use the guidelines by the Philippine Institute of Accountants. Okay? And then for the funding, here's where we really use the potential ROI of your fund. Okay? So it should reflect the future ROI of the investment allocation. No? So if you're heavy on government bonds, then it has to be nearer to the allocation of the government bonds. Okay. All right. So from the types of actuarial valuation, there's also another layer to determine whether your retirement benefit is a defined benefit or a defined contribution. Okay? But later, we will actually conclude that almost everything in the Philippines is a defined benefit. Okay? Anyways, let's go first with the HR lingo. All right? For a defined benefit, the company promise is a specific benefit at retirement. A popular example of that would be if you retire, I'm going to provide you 1 month's pay for every year of service. Okay, so you simply determine the tenure of the employee, determine the final pay of the employee, multiply it. That's it. Okay. For a defined contribution, the promise is based on the contribution. So it can be, for example, a company can promise that I will deposit 5% of your salary into a retirement fund that is actually based on your account ledger. All right. Or it can be an absolute amount. I'll contribute 1,000 pesos for you on your retirement fund. Okay. And then whatever is accumulated there, that's going to be the basis of your retirement pay. Okay. So that's defined contribution. So in essence, as how the accounting treatise has explained it, so the risk on DB or the defined benefit, the company bears the risk to ensure the promise is met. And then on DC plans, the employee bears the investment risk, okay? Because the retirement pay of that employee will now depend if the investment performs very well. On accounting, the DB plans is complex. It requires a full actuarial valuation. However, on a DC, it's actually simple. The expense there is going to be the contribution. So on a purely defined contribution retirement plan for jurisdictions outside the Philippines, there's no actuarial valuations for their DC plans. Okay. All right. So let's have an example. So this is a example of a defined benefit. This is the Philippine Default Benefit, which is Republic Act 7641, wherein eligibility is defined as optional retirement when you reach 60 years old with 5 years of tenure with the company. And it can be maximized up to 65. And that is termed as compulsory retirement by the Department of Labor. So the benefit you receive here is half month salary for every year of credited service. Okay? Now, half month salary, in terms of how the labor has defined it, it's actually a sum of three components. You have the 15 days pay plus the cash equivalence of the 5 days service incentive leave plus 1 over 12 of the 13th month pay. So that's why if you try to add this up, it's impossible to actually make it 50% of the monthly rate. So you know it's more than 50%. Okay? So as a guideline, most companies who are, let's say, 40 hours a week, Monday to Friday, that would be around 103% if you convert it. No? Okay? For companies, let's say, that has 48 hours, that's about 86% of the monthly rate. Yeah, because as the as the number of days increase, the daily rate of the wages goes down. Okay? So it decreases as the working days go up. Okay. Now, we now connect this to the defined contribution plan. Sorry. But before that, let's have an illustrative example for those who want to be familiarized with what the law provides. So let's say you were hired 2018 and you decided to retire in 2026, assuming that employee is age 60, is qualified for optional retirement. So there's a labor code example that uses, instead of trying to dissect the definition of the half month salary for every year service, you can actually use the 22.5 as a factor. Okay? So that's 22.5 multiplied by the daily rate multiplied by the years of credited service. So that's a gross retirement benefit of 216,000. Okay. Now, I want to connect this with the DC. So we call this the hybrid dilemma. Okay. That is when the DC becomes a DB. Okay. So why does the DC become a DB? It is because the RA 7641 exists. So you saw the example earlier, no? It's 260,000. What if the 5% that the company is giving you only, let's say it only reached 200,000? Okay? So the company has to shell out a further 16,000 to be able to meet the RA 7641. Okay? So let's explain this dilemma. Okay? Many companies have a DC plan, which is also known locally as a provident fund, and must also comply with RA 7641. So the rule here is the employee gets whichever is higher. It should be the DC fund balance or the RA 7641 benefit. So the result of this higher off guarantee creates a potential shortfall that the company must cover. Okay, so hence, in this past 19 treatment, because of this guarantee, the plan is valued as a DB plan. No? And this is further reinforced by, there's another PIC, or Philippine Interpretations Committee circular for that, which came around 2013. Okay, so that means we have to value retirement plans, whether it's a DB or a DC in intent, no, in the HR lingo, okay, as a DB in the accounting language. So everything now has to have a DB valuation. Okay. All right. So now that we have taken care of the what is a valuation, the difference, and what are the two types of plans. Okay. We now let try to understand the past 19, and there's a R there. No, it's a revise. Okay. So they just call it past 19 revised because there was an initial past 19 release around 2004 where it allowed amortization of some uh, expense components, no? But they eliminated it already beginning 2012. Okay? All right, so how to account for employee benefits? So again, as I said, liability is the one that you owe for past service, okay? So recognize a liability when an employee has provided service in exchange for future benefits. And then the expense is the cost of the current service. So you recognize an expense when the company consumes the economic benefit from that service. Okay. So the question now is, which reporting standard do you use? Okay. So in hindsight, we in Salamea really don't know what your reporting should be because we don't have visibility in your total assets or liabilities as a company. Okay? So we're very dependent we're very dependent on auditors' opinion, okay? And auditors, let's say they tell you that, oh, you have crossed the threshold, you should be reporting under this category already. Okay? But this one is a good summary, right? If you are a publicly listed entity, okay, so you're maybe listed in PSE, public company, or you have a purpose to go public, or you're imbued with public interest, maybe you're holder of a second license, then you should be reporting under the full PFRS, no? So that's the large size entity reporting under SEC category. Okay. So let's say you don't have this. Okay. The next determinant of that would be your total assets or total liabilities threshold. Okay? So it would be determined, do you have a total asset of 350 million or a total liability of more than 250 million? So if the answer is yes, then you are supposed to report under full PFRS. Okay? And full PFRS would mean the past 19 reporting. Okay? Now, let's say the answer to that is no. Then you're supposed to ask, maybe we're between 100 to 350 million for total assets or 100 to 250 million for total liabilities. Okay? In that case, you are supposed to report under PFRS for SMEs. For employee benefits, that's section 28. So if the answer is still no, maybe you're on under 3 to 100 million or maybe you're below 3 million, okay? Then you're supposed to report under PFRS for small entities. Okay? So the one with valuations there will be the full PFRS and the PFRS for SMEs. Okay. All right. Okay. So let's say you're reporting now under full PFRS, then past 19 actually covers all employee benefits. Okay, not just retirement, no. It's just that the valuations is only needed for a long-term benefit, no, the one in the middle. Okay, for the short term and the termination, you don't need valuations for this, no? So what are short-term benefits, no? So these are employee benefits that are settled within 12 months. A very simple example here is your salaries. Is our salaries, no? So we hope it's always paid within the 12 month, no? Within the 12-month period, or else we don't have disposable disposable income, no? In our day-to-day activities, okay? So the accounting for that is simple. It's accrual, so it's undiscounted. No, it's a simple and doesn't need valuations in general. Okay, your HMO coverage also, the fees provided to that, it's also a short-term benefit. Doesn't need valuation. Similar to termination benefits, so it's paid for ending employment. That is like a severance pay. Usually happens in retrenchment and redundancy. Again, it doesn't need valuation, no? Kasi we're not trying to predict whether people will be retrenched or redundated in the future, no? So, that concept is not really based on an ongoing mode of business, no? When we do valuations, when we do reporting, it's always on a going concern basis, no? Okay? So, just in case this happen, this severance benefits, no? It will depend on the timing and occurrence of actual events. So you expense as is, no? When there's a termination benefit. So the one that we are doing actuarial reports to is the long term because it's the one that is paid after employment. So the examples are the RA 7641 or maybe your company has a generous pension program. And the accounting of this is based on actuarial reporting. Okay. So how do we get into the final numbers? So definitely we will need your data. That would be concerning employees and plan rules. The assumptions that we use, discount rate, salary increase. Perform the valuation, which is the actuarial calculation. And then produce the key numbers, which is the liability and expense. Okay? And then finally, whatever we produce, this is what your auditors would reflect on your financial statement disclosure submitted to the SEC. Okay. So let's now go and build the valuation. So what are these data and assumptions? So for companies here or clients here that haven't done the valuation yet or are still completing the data, okay, so this set of slides will be very important to you. Okay, so it all starts with data. Garbage in, garbage out. Okay, so of course you need to provide us the most accurate data. Okay, so that we can produce the financial results equivalent to that data. Okay, so for employee data, what we require is the ID numbers, date of birth, date of hire, gender, and salary. Okay, so what's the ID numbers for? So we use it for correct tracking. If you are a consistent client of us over the years, so we're able to explain numbers or how the numbers move because there are IDs that we could actually identify. Okay? Date of birth is for age, date of hire is for tenure. The gender, we simply use it for mortality rates, no? Because it's a gender-based mortality rates that we're using. Okay? And then the salary, it must be based on the plan definition. Because the common question out there is, do we give the total compensation or do we just give the basic? Okay? Or do we give the bonuses? No? It must be based on how your retirement policy is set. Because I have seen retirement policies that says that it's just the basic monthly salary as the basis. Then, you have to provide us the basic monthly salary. Okay? I think about 95% of our clients would easily fall under that category. Okay? Now, there will be some, about a total of 5%, no? Either they include the allowances there or they even include bonuses there. Okay? So, it's very important that you check your retirement plan rules and regulations on that. Okay? So we will need the plan asset data if you have a funded retirement plan. So that would mean retirement fund statements that should come from your bank, contributions and benefit payments. Usually, the fund statements would already contain the contributions and benefit payments, but we use your declaration from the finance team just to counter check whatever is reflected in the fund statement. Okay? And then for your defined contribution plan, we also need the individual employer DC balances. Okay? Because we have to know if there would be a potential shortfall for a particular employee. All right. All right. So the benefit design matters. What does your retirement plan actually promise? Okay? Because the liabilities obligations is highly dependent on the retirement plan you provide. Okay? Definitely, the more generous the retirement plan would be, the more expensive, of course, it would be. All right? So the valuation must match your actual company policy or retirement plan rules, or maybe you have even have a collective bargaining agreement. And then adding benefits on top of RE 7641 will increase your liability, no? So this is just a simplistic illustration, no? Based on averages that we saw, okay? So let's say your RA 7641 represents one unit of liability. Having an early retirement, what's an early retirement, no? A benefit paid when someone is 50 years old and 10 years of service, okay? So once you put an early retirement, your obligation already doubles. Oops. Okay. And then there are some plans also with resignation packages. Okay. So that liability would further increase na kasi if an employee before resigns, no, and your benefit is only RA 7641, then you don't need to give anything. So that is cheaper. Okay. But now, if your employees resign, you have to pay something. All right? So that would mean about 4 times, no, of the unit of RA 7641. So that's just an crude estimation. Okay? All right. So the engine, actuarial assumptions. So our best estimates of an unknown future. All right? So based on the standards, assumptions must be unbiased, not too high, not too low. Okay. They must be mutually compatible or that they must make sense together. So there are two categories of assumptions, something about financial, which is the discount rate and the salary increase rate. Then we also have the demographic assumption, which is the attrition or turnover or mortality and disability rate. So simply put it, demographic concerns about human movement. Okay. Let's focus on the first one first one, okay, which is the discount rate. So what is this discount rate, no? Is it does Salame just get it from anywhere, no? No. So the question to that is no. Okay. So we use this to convert future benefit payments into a present day value because we're projecting benefits in the future. We have to bring them back, no, to the current period. Okay. How is it set? So we usually base it on market yields of high quality corporate bonds. Again, this is not your investment return. We use the posted BIBAL rates from the website of the Philippine Dealing and Exchange, no, Corporation. So that's from pds.com.ph. The impact of this is a significant driver. It also has an inverse relationship with your obligation and expense. So what does that mean? The lower the interest rate, the higher your expense and your obligation would be. Okay? So why is that, no? So let's say I promise you 1,000,000 pesos. So this is just a rough example. Promise you 1,000,000 pesos 1 year from now. If the interest rate is 10%, then I only need to deposit somewhere around 910,000, okay, to be able to fulfill my obligation of 1 million a year after, no? But if that interest rate is only 1%, then I need to, instead of 910, I need to shell out 991. Okay? 991 to be able to meet my obligation to you. All right? So it has an inverse relationship. And then as you can see here, no, at the at the graph at the right, so after the pandemic 2020, so it has increased up to 2022. I think it reached around 7.4% during that time. And then it went down, no? Parang it corrected in 2023. Excuse me. And then it has been sideways since then. Okay? And then a little bit going up in 2025, no? But if you look at this graph, no, from 2022 to 2025, it's just a sideways movement, no, in reality. Okay? So it's a market in waiting. All right, it's a market in waiting. All right. So if you look at the discount rate as of the year end, it's about 6.4%, no, compared to 6.09. So 6.40 siya. Okay? So that means it's a slightly beneficial valuation for companies in 2025. Okay. Ayan. Okay. All right. The next assumption that we will have to talk about is the salary increase rates and the attrition rates. Okay? Your salary projection rate should be the best estimate of long-term average salary increases. And the impact of this is that the higher salary rate would mean higher liability. Okay? So what should be the basis of your salary increases? Okay. Supposedly it's your future budget. You foresee or you forecast that this is the potential salary increases in the future. But in reality, a lot of companies would not have that estimate. All right. So the other way to look at it is let's look at your historical. Okay. So what has been the salary increases of the employees from the past 5 years, for example? So we can use that as a basis for your salary increase assumption. Okay. So if you look at here, so let's say you're an organization that only provides 2%. We call it a low assumption, no? If you look at the what do you call this? The increase in minimum wage, it's actually more than 5% lately, no? So if you're only providing 2%, sooner or later the minimum wage will catch up to you. Okay? But anyways, let's say the 2%. represents 1 unit. Okay, 1 unit of that obligation based on 2%. An organization using 8% as the salary increase assumption, definitely it's a high assumption. It would represent about 4 times, no, of the obligation if it was 2%. So again, crude estimates. All right, so that's the salary increase. Let's go to the second half or the bottom half. What is attrition? So sometimes interchangeable with turnover rates, withdrawal rates, okay? Or simply put it, rates of employees leaving before retirement. Okay, so what's the impact? At least for RA 741, higher turnover would mean lower liability. Okay? Which means fewer employees stay long enough to get the benefit. Okay? So the obligation of that for those who have a very high attrition, okay, for a very high attrition, 10%. So let's say that obligation represents 1 unit. Okay? For those who have a very low attrition, okay, you will actually get around 8 times, no? 8 times of an organization that has 10% attrition. Okay? So it looks bad in the numbers, okay? But you should be happy that you have a low attrition, no? So that means you probably have a much more stable employee organization, okay? You have continuity of business, all right? So what you actually spend on retirement expense, no? Hopefully you have a very good savings in terms of hiring cost, training cost, no? Or the cost of actually not having that stability of employees, no? Okay? Those naman who save on retirement expense, so those who have a high, definitely their training cost, their hiring cost is very high in that regard. So it's actually just a choice, no? Of which expense you would like to have. Okay. All right, so let's go for the application and impact. And this is very useful uh, for clients who already had the report. Okay, so this is an interpretation of the numbers, no? Okay, so what does this mean for you? All these valuation results. Okay, so first, how accounting valuation affect your financial statements? What your auditor and CFO will see. So on the balance sheet, it's a large non-cash liability that could impact your debt to equity ratios and loan covenants. Okay. For income statements, it's a volatile non-cash expense that will affect your reported profitability. And then for the equity, any assumption changes, especially the discount rate, would create volatility in your total equity. Okay. So let's have examples, no, on how we can calculate and how that will this impact your financial reporting. Okay? So there are two things that your actuary does. They try to compute for the present value of the defined benefit obligation, and they also try to compute for the current service cost. Okay? So the method as required by IAS 19 or PAS 19, it must be a projected unit credit with an actuarial calculation. So the main benefit formula treatise here will be the current monthly salary of the employees multiplied by the years of service. Okay? But you would also need the salary increase factor until retirement, the present value factor until retirement, and the survival of the employee until retirement, no? Ano ibig sabihin ng survival, no? Survival of the workload and stuff. No. What I mean there is that employee will be there at age 60, no? Any time that the employee exits, so that's the non-survival, no? So we have to compute the the turnover factor for that employee. Okay? Now, the computation of the current service cost is almost the same, except that the benefit formula is just based on the prior monthly salary. And then the salary increase factor, the present value factors, survival of employees is using the prior year assumptions. Okay? So the reason for this is current service costs are computed at the beginning of year assumptions. Okay? So that's how it is now. That's the difference of these two. Okay. So let's have an example based on a retirement benefit that pays 1 month's salary, 1 month basic salary for every year of service. Okay. Let's say this employee is 30 years old in 2024. So I just calculated the 2024 so that we just have a beginning up to the ending later. No? Okay. So this employee was 30 in 2024, definitely 31 in 2025. So plus one. 5 years of tenure in 2024, 6 years in 2025. So plus one. So he had the salary of 40,000 back then. And then yeah, he was granted a good increase, no? 25%. So from 40 to 50,000 in 2025. Okay, sana all right? And then the salary increase rate that the actuary used was 6%. But when we did the valuation, the client said, we are tapering off our expectations. So maybe just 5.5% for now, okay? And then the discount rate, these are actual discount rates, no? In year-end 2024, it was 6.09. And then it was 6.4% in 2025. All right. And then in 2024, the attrition rates is 10%. There was a client initiative to, well, let's try to improve our company culture. Okay. Then it was determined that the attrition now is only 5%. Okay. So let's see how it affects the calculations in general. No? All right. So for the 2024, I calculated it first. No? So 40,000 times 5, which is 200,000. Then the salary increase effect of the 6%. No? So that's about 5.74. The discount rate effect. Okay. And the attrition rate effect. No? Okay. So attrition rate effect here actually tells you that because there's a high turnover of 10%, it simply means that there's only a 4.2% chance that this employee will retire at 60 with this organization. Okay? So hence the obligation that we calculated for this person is about 8,265. Okay? Fast forward, so may beginning na tayo, na? So fast forward to 2025. There. So based on the data given to us, it's 50,000 times 6, so it's 300,000. We calculated the salary increase effect, the discount rate effect. And then as you can see, no, yung attrition rate, now he has 22.6% chance to reach retirement because the attrition improved. Okay? This time around, lumaki yung obligation, no? It's actually more than is this 6 times or 6 to 7 times, no? Or 6.5 times, no? So that's 52,981 for this employee. Okay? So hopefully you were able to follow that. Okay, so same data pa rin. This time around, ang ika-calculate naman natin is the current service cost. Okay? So we just need the prior year salary of 40,000. Use the same salary increase, discount rate, and attrition rate effect. So we'll get or calculate about a current service cost of 1,600. Okay. So let's now go to, ito yung nakikita nyo sa report namin, the present value of the obligation, which is the disclosure movement. No? As we calculated, sabi ko nga, in 2024, it was calculated as 8,265. Okay? So the first P&L component, which is the interest expense on the obligation, so it's simply the beginning balance multiplied by the prior year discount rate. That's 5,000 that's 503 pesos for this employee. Okay? And then we were able to calculate the another P&L component, which is the current service cost. So that's 1,653. Okay? Now, what's the goal? Itatawid natin yan going to the 52,981. No? So there will be other components in the next. No? Okay. So the first component of which is the actuarial gain and loss due to experience adjustments. No? Nag-recalculate kami based dun sa data ng employee, no? He has 30,000 pesos as a salary now. No, not 30. 50,000 pesos salary. And he's still there. No, hindi siya nag-resign. He's still there. Okay? So hence, an experience loss occurred for this employee because employee is still here. Diba? It negates the 10% attrition in the 2024 assumptions. Okay? He received a 25% salary increase versus an assumed 6% in 2024. So we calculated that actuarial loss. So that means we have to put in a 1 year additional, parang correction siya in some sort, no? Okay? 1,599 for this employee. Okay. Let's go to the next. Ito yung malaki. Alright? So, you can see naman how obvious it is, no? From 4% chance, naging 22% chance yung retirement niya, no? So, attrition assumptions have significant impact on actuarial calculations, particularly if the benefit is only under Republic Act 7641. So, the change from 10% to 5% attrition would mean that employee has higher chances of staying, thus higher chances of retiring with the company. So upon our calculation, it's 45,639 additional obligation. Okay, lastly, ayan, yan na yung tatawid, no, to 52,000. So after all the more expense, no, the positive numbers means more expense. So another other comprehensive income component, okay, which is the actuarial gain and loss due to change in financial assumptions. So nagbago yung discount rate natin. It's actually beneficial to the client, 6.09 to 6.4%. And we change the salary increase rate. Binaba natin, no? 6% to 5.5%. So it would lower the expense and the obligation. Okay? So nagkaroon tayo ng at least konting minus, 4,600. So we now round it up to the 52,981. Okay? So this is the reason we need your ID numbers. Kasi parang for every employee, nati-trace namin yan. Yung ganyan. Okay? So yan yung, all these numbers have their continuation story, no? Your valuation report actually tells you what transpired in the employee movement and the salary movement in the past year. Okay. All right. So from obligation, this is the next table that you see on a Salamea report. No? So we also put in there the fair value of plan assets movement. This is for companies that have retirement funds. So this is an advantage. No? You can use it to net it out from your obligation. Okay? So on a fair value of plan assets, we would need the prior year audited financial statements. Ano yung nakadeclare doon? Okay? We will compute for the interest income, which is in the P&L. And take note, interest income here, no? You can see there's a formula. It's not the actual return of the fund. Okay? So it's a theoretical interest return based on the accounting guidelines. No? Okay? Contributions and benefit payments that affect the cash flow is copied from the fund statement. Remeasurement gains and losses, which goes to the OCI statement, no? It's the difference between an actual return and the interest income calculated here. Okay? And then finally, the ending is the one that is declared on the company's retirement fund statements. So not much actuarial things going on here, no? Talagang copy lang siya from the retirement fund. So this is an example. Let's say from your favorite bank. Okay, from your favorite bank, this is what they gave. May retirement fund of 8,000 pesos for that employee. Okay. The company decided to contribute 7,000 pesos. Okay. And then it actually grew by 1,000 pesos. So that's 16,000 pesos on the year end, no? So how will your actuary use this into the into that table, no? So this is what will happen. So the beginning in past 19 is 8,000. And then ito na, no, interest income is 700 pesos. So kinompute namin yan using your beginning plus the contribution midway multiplied by the discount rate in 2024. So that's 6.09. Ang na-compute is 700 pesos. Okay? We will reflect the 7,000 peso contribution and then the difference of the actual return, which is 1,000. You subtract the interest income of 700. So meron tayong remeasurement gain of 300. And then ending in 16,000 pesos. Okay? So now we're ready to put all the numbers earlier. Okay, all the numbers earlier. Mapupunta rin siya dun sa statement of expenses natin. Okay? The one is the P&L and the second one is the OCI expense, no? P&L expenses constitute the regular year-on-year expense of a company for retirement. Okay? But for OCI, this is the irregular expense of a company because it can fluctuate from time to time. No? Sometimes it's a gain, sometimes it's a loss. No, favorable, unfavorable. So anything that is fluctuating goes to the OCI. Okay. So let's see. No, we computed earlier the service cost. May dalawa pa siyang component na kasama, no? The past service and the settlement gain or loss. I'll explain to this on the next slide. Okay. But for now, it's 1,600 total service cost. And then yung na-compute natin kanina, no, interest expense on the obligation is 503. Deduct the interest income on the asset, which is 700. So the net interest expense here is 197 income, no? So the total P&L now is 1,456. So ito na yung total expense in the P&L. Okay? But for the OCI, so yung mga kaninang computation, no? So it's a total of 42,560 for the actuarial gains and losses. May maganda tayong remeasurement gain kasi kumita yung fund more than the interest income calculated. So that's 300. So your total OCI expense is 42,000 during the year. Okay? Now, companies that are reporting under PFRS for SMEs, parehong-pareho tayo ng dynamics. Ang exception lang is that actuarial gains and losses like this, instead na now sa OCI siya, it can be recognized on the P&L. Okay, so there are companies or clients that we have that chooses to actually have the gains and losses in the P&L. Okay, so you just add it up kung yan yung situation natin. Okay, so from statement of expense, ayan. So, ito yung sabi ko, no, there are two more things there, no? The settlement gain and the past service cost. So, kailan nangyayari yun? Whenever there's a special event, we call it the curtailment or the settlement. So, it happens when we ask the question, what if we downsize or change the retirement plan policy? Okay, so it can happen when you have an amendment or introduction of plan, a curtailment wherein there's a significant reduction in employees. Usually, ang barometer namin dyan is 20% reduction and then yung attrition rates na nagamit is less than, let's say, 10%. Okay, so that means the company was not actually aware when we were doing the valuation previously that they will actually reduce employees. No? And the settlement, no? So yung mga severance payments actually goes here, no? Dito sa settlement gain and loss. Okay. So all of these events will require special calculations. Okay, so may additional work kaming ginagawa for that to recognize a gain or a loss in the statement of profit or loss. So, you must inform us of these events if it has occurred during the valuation year, and further information might be required for assessment. Okay. All right, so we're going to the last tables, no, that is required for accounting reports. So this time around, this is the net liability. So the obligation we calculated earlier is 52,000. We have a retirement fund amounting to 16,000. So that's a underfunded status of 36,000, which will also reflect the net liability of the company. Okay? So underfunded plans will have a net liability, which is the amount of overfunding, underfunding rather, while overfunded plans will have a net asset where the surplus is subjected to an asset ceiling. Okay? Ano yung asset ceiling? So, bihira kasi, no? It's very rare that there are overfunded plans in the Philippine setting. Okay? Asset ceiling is simply the standards way of not letting you book money that the company cannot actually get back or use. Okay? So, yan yung computations niya. Okay. Now, there's another way of presenting your net liability. It's actually to try to bridge your previous net liability to the current net liability. So remember earlier, meron tayong I think maliit na obligation, and then meron tayong 8,000 pesos worth of retirement fund, no, during the beginning. So it resulted to a 265 in 2024. So i-add up mo yung P&L expense, add up the OCI expense that we calculated, and then deduct the contributions that the company has made. We should end up with the same amount of 36,981. Okay. All right. So we come to the end, no, of our presentation. Okay, we'll go to the Q&A after this. So key takeaways or what to remember, if you have employees, no, you have at least an RA 7641 obligation. This is a DB that needs a past 19 valuation. This is not just a paper exercise. It directly impacts your balance sheet liability and P&L expense. So assumptions are the engine, discount rate, and salary projection rate are the most significant drivers. Hopefully, if you are our continuous client, you're providing us accurate attrition numbers in the past 5 years. So, hence, the effect of attrition over the years should taper off. Okay? Start your valuation today if you haven't yet. Okay, quarter one. Don't wait for the government deadlines. No, it's best to actually still have wiggle room before the eventual submission to the SEC. Okay. All right. So thank you. Please email our proposals at salame.ph to start the evaluation process by providing your latest headcount. So with gratitude, RB and I, okay, so from the Salamea team, thank you for the patronage of our services and for actually, hopefully you were able to learn from the presentation that is made today. Okay, so we're now going to enter our Q&A segment. All right.
All right. Yeah, thanks, Marv, for sharing to everyone how to interpret the results, how to go about it. And there are a lot more questions here, so hopefully we get to respond to most of them. So I've seen several questions asking, how do we start the process? Now, where do we start? So the first thing I think is what Marvin flashed earlier, which is to request a proposal. And to request a proposal, we just need your head count. So the employee head count, so that we can draft the proposal together with the scope of work and then the list of requirements. So I think that's the first thing that needs to be done. All right. Marv, you have questions on your end? Let's just alternate.
Yeah. let's do it. Actually, there's none in the Q&A. So I'll look at the chat box first. Okay. Oh, thank you for the attendance, no? I think there's a group here that's in full force, no? I won't mention her name na lang, baka mamaya they're ano, but I think they're in full force. Okay. Okay. Good morning. So this is from Mr. Paul Enriquez. Okay. Just to confirm, if we fall under the PFRS for SE, it means we're not required to recognize long-term employee benefits. Or is there a simpler way to recognize the long-term employee benefits for PFRS for SEs? So yes, so we did not cover the PFRS for SE simply because it's not about valuations, no? So you don't need valuations for that. It's a simple and straightforward calculation wherein your obligation is the current salaries multiplied by the tenure. Okay. Unfortunately, although it's a very simple, no, you can actually just use a Excel file for that. Unfortunately, because you don't have the advantages of the attrition, other factors that I mentioned in valuations, your obligation would tend to be on the high side. Okay, so that's an unfortunate consequence of having a very simple reporting, but yeah, that one. No? So you're recognizing full amounts there in the SEs. No? Anyways, if you do need support from Salamea, we can still prepare. It's not a valuation report, but we can still prepare an accounting report based on SEs, just in case you need our support for that. Okay. Uh,
Ako
I'll
muna,
go
Marv.
for the next. Yeah, go ahead,
Okay.
RB.
There's one question, anonymous attendee. Hi, RB and Marvin. Our pension is overfunded by almost twice our normal cost for 2026. Management is still keen on contributing to the fund. Is there a limit to what we can contribute to the fund? So, thanks for that. So in context, no, one factor in the valuation is the normal cost, which pertains to the recommended annual contribution. However, you would still need to look at the past service liability or the underfunded. So, if for example, usually the overfunded or the underfunded or the liability amount is usually much more than the normal cost. So that means if the management would want to make additional contribution beyond the normal cost, then it would be applied to the past service liability. And when you apply that, it would still be tax deductible. It's just that it's gonna be spread out over 10 years. So it's gonna be a little bit technical. My advice is we could probably have a meeting offline to discuss this further. So just email us in the email that Marvin, I'll just type it in info@zalamea.ph. Yeah. Thank you for that question.
Okay, so I'll just go to the chat box again. This is from Miss Agnes Landig. Okay. How do you determine future attrition rates? So there are three ways to do that. First, we have a Salamia table actually that starts from 7.5% and then has a attrition of 2% when you are already age 40. So this is a table good for organizations that have 5 resignations for every 100 employees, no? So 5 over 100, no? Now, just in case that is still not suitable for you, then the second possibility is that we collect your attrition data, your resignation data for the past 5 years. Okay, determine what has transpired for every age bracket. Okay, then whatever is in there, that's the attrition rate that we will use for our valuation. So it's an average of the 5 year. Okay. Um, and then from time to time, we would have to determine whether this is still suitable for the company in the future. Okay. So that's the attrition rates. Okay. I'll
Okay.
take in another one, RB. Okay.
Go ahead.
So
Yeah.
there's a question from Miss Eliza Chewy. Okay. Would like to confirm if we need to pay anything based on past 19 for any resignation, not termination. So if you're asking whether you're required to pay resignation benefits, okay? So of course the answer to that is no, okay? It must be dependent on your policy. Uh, An existence of a resignation policy would mean that you have to pay resignation. But if it's not, then you don't have to pay anything. So again, I understand your context here that it's not a termination benefit. Okay? Right.
Sige, the next question, anonymous attendee, we requested for a quotation for year ending March 2026. But we received a proposal for a 3-year valuation. Is it possible to be quoted only for the year we requested? So thank you for that question. In the accounting valuation or past 19, when it is the first time that you are doing this, say the first time you're doing it is for 2026, the requirement of the accounting disclosure is to have a comparative result. So you can't just present a year-end 2026 computation. You also have to have the beginning balance, which will be the year-end 2025. And then you need the transitional liability, which is um, 2024. Okay? So that means if it is your initial adoption, you really need to go back at least 3 years. Now, once that has been established and you have recognized that in your books, then for the succeeding years, it would just be 1 year valuation that will be necessary. So, that's why in the proposal you were surprised to see that there are 3 valuation dates because it is your first time adoption. So I hope that clarifies your concern.
Okay. Let me take in the next one. This is from Miss Donna Robles. Okay. Yeah. Sorry, I think I misquoted the wrong name. For those who are requesting for the presentation decks and recording, so I'm not sure if we were able to gather your emails when you sign in. When you sign up? So just to be sure, kindly email us at info@salamea.ph if you wanted a copy of the presentation deck made earlier. Okay. All right. So I'll just go to another question again. All right. So our company recently was categorized to SE, small entities from SME. Does this mean that we no longer need evaluation for 2025? Yes. So the straight answer to that is yes. You will just have to discuss with your auditor how that transition would look like. So meaning if you are on a reporting wherein you have a you have a valuation based on a smaller number because we're using attrition rates, etc., no, which you will not have when you are in the SE reporting. So your number might jump instantly just because of that. So you have to discuss with your auditor the impact of that. Okay.
Okay.
Right.
Marv, I'll take the one from an anonymous attendee. For companies with a private plan, with shared contribution, like if, for example, employee shares 4% and then the employer contributes 4% of their monthly salary, is the 4% share of the employee considered non-taxable compensation or is it still taxable on his monthly compensation? So that's a good question. So we're talking of employee voluntary contribution to the retirement fund. So current laws would not allow this as tax deductibility for the employee. So therefore, when the employee receives his net pay for the month, meaning after tax, that's when you would make the or deduct the contributions to the retirement fund, the 4%. So to answer your question, it is not, it is after tax contribution in behalf of the employee. So hindi siya tax deductible expense for the employee. Okay.
Okay. All right. So this one, I think this is one setup question. If overvalued year on year, should the rate of remittance to the plan be reduced? They said that their PSL is also funded. And if both past service and normal costs are overfunded, no? So the answer to that is yes, definitely. You can reduce your remittance of contributions to the retirement plan. Anyways, contribution is company a company's prerogative. No, there's no mandatory funding of retirement plans in the Philippines. No, so it's a company's prerogative. So if you feel that you can actually use the cash for something else, then you might want to suspend contributions for now or reduce your contributions for this year. And then let's just determine it again once we do a funding valuation 2 years from now. Okay, right?
So, Marv, there are difficult questions regarding journal entries. We'll try our best because we get this question also several times. How should retirement journal entries be recorded? And how can we reconcile and verify the balances in our books with retirement valuation report? So, during the year, you would normally recognize accruals, right? Now, the accruals will be based on estimates. Now, at year end, when the valuation report comes out, there would be the final expense to be recognized in the books. So when you close your books, it would be the expense recognized in the past 19 report that you need to disclose. Therefore, there would be accounting entry adjustments that need to be done. So the exact entries that need to be put in would be, I forget what it is, but it's an accounting adjustment entry that needs to be put. So the final expense would be what would come out from the valuation report.
Okay. I think I think that question no, came from that big group that is actually participating to this webinar. So I feel that your question is much more specific. We can actually discuss this offline. Okay, I'll get in touch with the one that I'm also corresponding with in terms of the valuations for this group. Okay, all right.
I'll just follow through now. The one who asked about the quotation and received a 3-year report. I think it's either because it was requested for 2026, but they claim that we also coded for 27 and 28. So I think this means that it is when we do our proposals right now, there's a 3-year lock-in period. So this would mean that next year you don't need to request for a new valuation for a new proposal because the 2026 fees will just apply. And then for 2028, the 2026 fees again will apply. So it doesn't mean that you will do all three valuations today. So you're just gonna do the 2026. Next year, we'll remind you do the 27, and then the year after do 20. So I hope that clarifies it. So probably we have room for last two questions, Marv.
Yes, no worries. No, I think there's just one more, at least the one that came into the QA box. So we are a U.S. representative office. This is from Donrick Medanilia, okay, which is exempt from corporate income tax. So just to confirm that we are not exempt from PAS 19, major change on structure before it's a ratio of 7 employees and 150 consultants, okay. Mid 2025, all are converted to employees. We are SME pa. All right. So you actually gave the answer at the last one. So it's not a PAS 19. The mere fact that you said an SME, then you should be reporting under PFRS for SMEs 28. And then, as a consequence, we will have to perform actuarial valuations based on retirement. Right? So, by the way, don't be scared with the expense and the cost of the valuations. it's just a small fee compared to the potential headaches and hassles that you might make when you don't do a valuation. Okay. So that's my advice. So maybe we can discuss offline. So we can prepare a proposal for you wherein we'll be able to um, calculate the retirement obligation for your employees. Okay. All right.
Okay, so I guess
Okay.
that concludes this morning's webinar. So, Marv,
Yes. All right. So thank you very much for participating, Joy. We appreciate your questions. Okay. It's actually keeping us the one keeping us very
busy.
into this. No? Yes. Okay. All right.
So yeah, so thanks everybody. Thanks Marvin for today. This won't be the last one. There are a lot more questions that are coming in. We'll have another session probably in in February or early March about this as more and more of you would complete your valuation and would need help in interpreting the figures. So we're always here to guide you. But please email us anytime, if you need further assistance and the analyst assigned to you, feel free to utilize them as well. So to all attendees, thank you for joining us and keeping us company till the end. Thank you for all your questions. And we look forward to seeing you in our future webinars.
All
Have a good
right.
day, everybody. Take
Have a
care.
great day ahead. Bye. Thank you.
Thanks, Marv. Thanks for all the
Thank
notes
you.
on the chat box. We appreciate it. Thank you for yeah, the messages. Okay, bye everybody.